Where are you, Micah?
Mr. Ford, I'm on my front porch.
Oh, nice.
Yep.
Nice. I should go upstairs on my. I'm at one of my. So we're actually recording on lakefront luxury today at
Oh,
our
sweet.
house.
Sweet.
So I don't know. I can't be in my house, so I'm on one of my rentals right now.
Oh, yeah. Yeah.
So
Yeah, it was nice to add a little workout this morning and then took the dog for a walk, went to Holly's, and now I'm sitting on my beautiful porch, which we're uh, about to renovate the porch. So we did, the ceiling's already done and just gotta sand down the floors and we're gonna put up some planter boxes and some other stuff to make it all look fairly.
it looks good. Looks
Yeah,
good.
it's a really nice, it's a big wraparound porch. So it's just, I mean, you've never been in my house, but it's like giant century, white
I've
century.
been out front. I've never been in, but I
Yeah.
picked you up, dropped you
Oh
off.
yeah,
So
right.
yeah,
Right.
yeah.
So yeah, it's a really nice porch. So dog likes it, wife likes it. It means I like it.
Right.
Yeah.
Well, if Callie's happy.
If Callie's happy, everyone's happy.
Yeah.
Hey, can you guys hear me?
Hey,
Yeah.
Brent.
How's it going? I'm driving. I haven't done this before. So,
So
hi.
driving or mastermind?
I haven't driven before.
First day.
No,
First day.
first day driving. Yeah. So I just
First time
wanted
Congrats
to
on
make
coder,
sure
getting,
this
long
would
time
work.
driver.
yeah, congrats on getting your G1.
Thank you. Thank you. You're allowed to drink, right? For the G1?
Yeah. Yeah, this is definitely recorded. So there we go. Good start.
Okay, I'm gonna mute myself now.
No, you're good. So I got a little bit of an intro for you. We'll go through that as people kind of pile on here, um then we'll get going. So Kyle, these because they're recorded and I'm transcribing them, what we'll do is we'll have the recording on our site, on the collective site, and then we'll take the transcription and we'll create a blog.
Go.
So then
Okay.
you can use that. It'll be on
Very tech forward.
very tech forward, yes. We
Oh,
do,
are you
yeah.
frozen or am I frozen?
You're frozen. I can still hear you.
Oh, okay. You were frozen there.
Oh, was
Must
I?
yeah. Looks like I got strong bars here, so.
Yeah, I got full Wi-Fi.
Oh, I got one. We're not recording yet, are we?
We are, but I can pause it. To resume. Thank you everyone for joining us. I'll let people in and monitor their questions in the event that you have them throughout the hour that we have Kyle Ford with us today. But let's get going. Kyle Ford, thank you so much for joining us today and agreeing to do this. For all of you that don't know, Kyle is the proud owner of CapGap and Banox. He's a business partner, he's a friend, and I'm really pumped for you guys to better understand what his business does and what he's going to talk to us about today. It's all about where capital is moving in today's market, what opportunities that investors are pursuing, and that he's seeing and helping investors pursue, how he can help realtors, just like all of us on this call, better understand the investment landscape, create more value for our clients. And today's going to answer exactly those questions. Kyle's not only an entrepreneur, he's an investor, he's an operator across three core platforms that sit at the intersection of private lending, real estate investment, and capital deployment. So when you pull back the curtain on how each one of these platforms operate, where the opportunities are right now, and what's actually happening with capital in today's market, that Kyle's and what he's going to talk to us about today. So without further ado, Kyle, thank you so much. Appreciate you taking the time, and the floor is yours, my friend.
Thank you. Can everyone hear me okay?
Yep.
All right. Okay, cool. So I'm going to try to, Micah, did you give me share permissions here?
I sure can, yeah. I think
Yeah.
you have them already.
All right. Can we see that okay? Thumbs up?
Yep,
Yeah.
you're
Okay.
good.
So I'll start with appreciate the kind introduction, Micah. You humble me. I appreciate all that. I'm today we're actually it's pretty cool. At our house we're on some TV show, some lakefront listing show. So there's a bunch of camera crews there. So I'm in one of my rental properties trying to do this. So I don't have two screens. So I'm on one. So bear with me here. I'm going to go back here. And how do I go? Okay. So I call this presentation Building Wealth Through Real Estate Lending, Investments, Through Partnership Lending and Equity. I do have a bit of a presentation. There are somewhat of some offerings at the end, but I'm going to kind of keep this value first. I want to talk about how you guys can use real estate investing as a tool to grow your business. It's something that I firmly believe in. I was a real estate investor before I was a mortgage broker. I was certainly a real estate investor before I was a real estate agent. And it's something that has helped me a lot throughout my career, my life, my personal, all of those things. So for anyone who doesn't know me, the companies, these are the five main companies that I kind of work with. We are in a consolidation process. Branding is super confusing. We're actually moving to two main brands, which is CapGap Mortgage Solutions and Banox Investment Trust. So essentially, CapGap is traditional private debt as well as mortgage brokering. So we work with the banks, we work with B lenders, and then we have our own private capital. And then Banox is private equity. So that's an opportunity where you can actually participate and own real estate. And this is another solution that you could be talking to some of your clients about. If you're a realtor and somebody's looking to invest in real estate, there's ways that they might not even know existed. So that's a little bit about what Banox is. Talk to you a little bit about who I am for anyone who doesn't know me. I am a mortgage broker. I am an EXP realtor. First and foremost, I'm a father of two, soon to be three in November. My lovely wife Chelsea and I, thanks Micah, my lovely wife Chelsea and I are expecting our third, not particularly planned, but we are excited. I like the joke, professionally I collect titles the way other people collect hobbies. I got to work on my elevator pitch. It's hard for me to explain what I do in 30 seconds or less because I do a lot of different things in real estate. So, private lender. The one thing I like to talk about a little bit, because I've got people coming into the office and asking me different real estate questions. Part of the premise that I base a lot of my real estate investment thesis on is I was a financial advisor in my previous life. So I do have that traditional financial planning approach that I believe that you got to take care of your foundation first, be in a good, strong position. And once you're in that strong position, then you can take on additional risks, take on investment, and then grow your portfolio in that sense. I think that's really important for the realtors on the call as well. I'm having a call with one of Micah's clients that he introduced me to, and they're looking at doing a deal that's kind of like not really in a traditional buy and sell transaction. And it's important to understand that when I'm talking to these people, I do understand the world that they're coming from. Buy a house, get a mortgage, pay it off, save RRSPs. And if we're going to do something outside of that traditional realm, it's important that we can understand their position they're coming from and where they're going in the future. So on top of that, I mentioned I'm a real estate investor first and foremost. So I have a large portfolio of investments. I do development, rentals, all of those things. Podcasting, check out The Hard Truth. Mike has been on it. I think Towner, I think you got to come on it soon. I think there's some other folks in this call who are going to be on in the future. So check out The Hard Truth podcast. It's all about giving value. I want to talk a little bit about the current market. And this is really from the investment side of things. And I think it's important that I give you guys a bit of a split view that I operate under. One of the first things that I always ask is your client a consumer or an investor? And I mean that very specific to real estate investment. If somebody is buying a house to live in, even though it might be an investment in their eyes, it's more of a consumer transaction. They're going to live in that house. They want a white picket fence. They care about the neighbors. They care about the school district. And that's the consumer side. I deal in the investment side of things. So people who are not buying to live in, they're deploying capital into the market and they're using real estate somewhat as a commodity to build wealth. So right now, we are seeing a major split market in Ontario lending. And this has been going on for years. And this isn't even exclusive to lending. This can be exclusive to a lot of things that we're seeing right now. But there's the banks and the A lenders and B lenders and private lending. And the division between these is becoming more and more clear. The bank is either fighting for your business and giving you the most discounted rate, or they want nothing to do with you and you're going into the alternative markets. It's important to understand that, especially on the investment side, we have a lot of extremely qualified people who are borrowing private capital. And this is a bit of a shift that I think a lot of realtors do need to understand, is going private isn't a sign of bad financial health or bad financial position. Going private can be a tool that you use to accelerate your real estate investment growth. If a lot of the times we hear like, oh, they need to go private because they lost their job, they have bad credit, they're self-employed. But if you're buying an investment property that's not financeable by the bank, you might be going private because you're going to acquire, renovate, improve, and then go back to the bank. So it doesn't need to necessarily be a negative context to go private. And now more than ever, we are seeing extremely qualified people in the private space using it as a tool to accelerate their real estate investment growth.
And Kyle,
So
Kyle,
yeah.
one thing I guess in the client that I sent you, just so from a real estate perspective, like my client is a traditional home, right? They found a property in Mount Pleasant that was, I think it was either somebody ran out of money or somebody died. We don't know fully, but the renovation was half done. The electrical and plumbing wasn't connected. They didn't have any board, didn't have any floors, didn't have anything, and it wasn't even connected to hydro to the street. Right. So no traditional financer is going to take that because it's not livable. So that was the first thing in my head. I was like, all right, I got to put this with somebody else, because if they want to finish this renovation, they can't afford just $500,000 out of pocket and then renovation budget. So that immediately was like, hey, that's a Kyle Ford deal. Send it to Kyle, get some traditional or non-traditional funding to help them actually create and build out this project. And then at that point, you would go to more of a traditional funding, bring somebody in, reevaluate 80% loan to value, most likely, and then put a traditional mortgage on it.
And to further go into that, because just so everybody on the real estate side understands, when a bank finances a property, they're looking at the person first and foremost. So you got to have verifiable income, you got to have good credit, source of down payment, all of that stuff. That's what the pre-approval is. But once the pre-approval is done, the very next thing they're looking at is the property. What are we lending on? What is the asset we're lending on? And the habitability test is what Mike is referring to. The properties that a bank lends on need to be marketable and habitable. So the test that's easy to apply here, if I'm a borrower, I'm somebody who's going to go in and get a mortgage on the property. Can I go into the house on the day of closing? I'm going to close on a Friday. On Friday night, can I sleep in a heated house? So if it's February, is there a verified heat source? So, okay, there's a verified heat source. In the morning, can I wake up, go into the kitchen, cook myself breakfast, wash the dishes, then can I go use the toilet, flush the toilet, and take a shower? And that's a pretty standard thing for most people when they start their day. And if you can't do those things in a house, it's not habitable and a bank will not finance it. So it's also really important when you're talking about, maybe if you're a realtor and you're listing a property and somebody's like, oh, this bathroom's just so disgusting, we're just going to gut it and let the new person deal with it. You may, but even if it was disgusting, if the toilet flushes and the shower works, the property's habitable. If it doesn't and there's no other toilet, you may have maybe made this property not financeable and limited your potential buyer pool. So it's an important thing, and I know as realtors we're not wanting to give mortgage advice, but these are some things that are really important to be aware of that can really impact things. I've heard of people saying, oh, we just the cabinets were gross, we ripped the kitchen cabinets out. The new buyer, we're just saying, put in a new IKEA kitchen, pick your thing. Well, now you don't have a kitchen at all, and this isn't financeable, so you've really impacted the value. So it's important to understand from both the opportunity side, but also the risk side as a realtor. So key market drivers, so renewals. I don't know how much you guys are hearing about this. This is a really interesting thing here for me. And some people are shocked when I hear this because I've had literally dozens and dozens and dozens of mortgages, 50 plus mortgages over my career. I've never taken a mortgage to maturity. I'm always refinancing, renewing, changing over before maturity. But a Canadian thing is we really put a lot of emphasis on our maturity dates. It's amazing how many people plan their vacations, their children's birthday party, everything in their life around their mortgage renewal date. And in 2026, it's one of the largest renewal as a country that we're seeing. It's 50% of mortgages, or a really high percentage of mortgages, are renewing. And this was anticipated to create major forced demand. Now, the good news is rates have settled a little bit. Like if you're an A qualified client right now, you can get a rate in the 3.5 to 3.7 range. So it's not this headline doom and gloom situation that we're seeing. There are good opportunities in today's market to get a good interest rate. So we were expecting to see this huge wave of people in higher rates being forced to sell, and that is happening, but at a less extent. It's not the huge wave. There are people who are forced to sell, but there are a lot of people who are able to manage, and the rate hike isn't hitting them that hard. But the point I'd like to make is it's amazing how much emphasis that people put on their renewal date. And as realtors, you guys probably hear it all the time. Oh, my mortgage renews in June, so it's got to be sold by then. Well, you could roll into an open, and it will just cost you a little bit more interest for a couple weeks if it doesn't close June 1st on the day of your renewal. So there's easy things that you can do, but it's amazing the emphasis. And I like to talk about this equity-rich cash flow poor borrowers. So a large segment of Ontario homeowners have substantial equity but struggle with servicing costs. So we see this a lot still. There are solutions for these people on the real estate side of things. If somebody's struggling, I used to be pretty anti-reverse mortgages because they're not great from a financial perspective. But there's a lot of scenarios where reverse mortgage makes sense for people. So before we go and sell the property right away, make sure they're looking at their financial situation and see if there's a mortgage solution that fits them. And maybe they do still need to sell the property, but a mortgage solution could buy them some time to sell in a better market, maybe be a less motivated seller. So there's some considerations to make there. I call this a group therapy session. So a lot of people have seen this chart. This is the market cycle, and it's not this clear and this defined. But this is kind of what, if we talk about, can you guys see the mouse? Oh, if we talk about this area, the euphoria, this is 2022. Everybody wanted to be a real estate investor. Everybody was getting in. The family dinner, people were buying pre-construction condos, they were buying rental properties, they were investing and lending, and everybody and their brother wanted to be a real estate investor. And what we've seen from that is it's a significant decline in the market. And it's interesting that it kind of corresponds with these emotions. And I like to ask, and I don't know if this scenario will work, where do you think we are? Or where are we in the market? And the answer for me is somewhere between capitulation and skepticism. So we're somewhere near the bottom is my projection. Do we have a little bit more ways to go? Maybe if you're a condo in Toronto, you do have a little bit more ways to go. If you're a nice 4-bed, 3-bath with a double car garage on a nice lot in a nice area of Kitchener-Waterloo, maybe you're more like here. So the asset types really do affect where we are in the market. I love the question, how's the market? Well, it depends. Are we talking, hey, Callie, are we talking farms? Are we talking condos in Toronto? Are we talking cottages in Grand Bend, single family, multifamily? The question of how is the market really depends on the asset classes. And we're going to kind of talk a little bit about where the market is still hot, where there's still opportunities, where there's still ways that that people can still invest in real estate. Am I buying pre-construction condos in Toronto right now? I could argue that it's not a bad time to buy a pre-construction condo in Toronto, as long as you're not trying to sell it in the next 24 to 36 months. If you're going to buy low and hold for the next 5 years, could turn out well. I believe it's called Jetsco or Jet something. A big Montreal-based firm just put in a bid for $500 million in dog crate condos in Toronto. So some of the big money is moving and taking advantage of where we are in this market.
Well, Kyle, I
We're all
think
transition.
that was a
Yeah.
conversation we had even not too long ago with some of the pre-con stuff even locally. Like, does it make sense to create a fund or a REIT and assist in some of these non-built condos and say, listen, we'll take 20 of them and do a fund that will, allow them to build and then hold these things for 5 years because you're getting, what was traditionally $1,000 a square foot at, say, 550, 6.
It I think that conversation we had ties really good into this slide. The best investments might not feel like it's the best time. The people who bought a pre-construction condo in 2021 thought they were the smartest people in the world, thought they were ahead of the times and they were the best investment because it felt good. All the headlines, everything around it felt good. Where we are today might not feel as good, but when you watch the big money's positioning. I saw another article, Berkshire Hathaway. We shouldn't call it Buffett anymore because I guess he's kind of stepping back. But Buffett's former company just made a big play on a U.S. real estate, 6.8 billion committed. Or so the big money, that Jetsco, the Montreal firm, and the Toronto condo, these big money are moving towards. They're acquiring. They're taking advantage. While the retail consumer market is, reading the headlines and the doom and gloom and waiting for everything to feel good, waiting for it to feel safe. The big money is positioning itself for opportunity. So what I like to say right now is, I like 6 months or 5 year deals. So, and here's what that means. I like deals that I can be in and out of quick because I don't have as much exposure to the macro. So the one man's Twitter account's not going to affect my investment as much in a 6 month window. So we're funding a lot of flips right now. People who are buying at a deep discount, they're buying at 60 cents on the dollar or 40 cents on the dollar, spending 25 cents on the dollar, and listing at 90 cents on the dollar. So they're listing on the market, pricing it to sell, turning over those properties quickly, and moving the capital. The other thing I like is projects that have a longer time trajectory. So you're going to see some of the opportunities that I have are 2 and 3 years, but the projects themselves have a longer time horizon where we don't need shorter term liquidity to be profitable. So those are some of the concepts and ideas that I'll talk about. So the question is, and I want to provide value for both sides. Is there an opportunity as realtors to attract investors right now? Absolutely. Is there deals for them to be had to be out there and do deals? Absolutely, where you guys can be earning commission, selling properties, buying, selling, trading. The other opportunity that could exist for people who don't want to be as boots on the ground is participating with some of the institutions. So now, am I Berkshire Hathaway? No. Am I Jetsco? No. But I offer funds and solutions in ways that more of the retail market can participate in larger scale real estate investments. So as I kind of go through these, they are offerings that you can invest with me or your clients can invest, but I want to make sure I provide value for you guys, so from an education perspective along the way. So absolutely, I'm going to talk about some of the different products and ways people invest in real estate. I got to give you the disclaimer before you do any investment, give you legal advice, review the documents, all that stuff before you do any investment is a must. So I'll talk a little bit about CGMS, so CapGap Management Services. Eva, you're on the call. Remind me this needs to be updated to Mortgage Solutions. We forgot to do that. The name just changed. We are officially CapGap Mortgage Solutions. The sign in the office already says that. The legal entity is now changed. So this is a way that you can be the bank. Do we think banks make a lot of money? I'll say yes. I would say TD just posted an $8 billion quarterly profit. So we're going to go with yes, the banks make a lot of money. Do as the banks do, not as the banks say. Do as the banks do, not as the banks say. So the banks say, put your money with us, keep it safe, we're going to protect it, we're going to take your money, we're going to put it on the shelf, and when you need it, it's going to be there, and we're going to give it back, and we're just going to give you 1% interest. Is the money sitting on the shelf? No, it's not. What is the bank doing with the money? They're investing it. They're lending it. They're turning it back, and you put your money in the bank. They give you peanuts on the interest rate. Then they charge you 5% on your car loan, 5% on your HELOC, 10% on your unsecured line credit student loan, 20% on your credit card. They're taking the money that everybody has there, and they're paying peanuts and lending it back at a profit. What if you could be the bank? So CapGap Management Services, now Mortgage Solutions, offers syndicated solutions. So if your first thought is, okay, so I like the idea of this, but I can't lend $500,000. I can lend 100 grand, I can lend 200 grand, but I can't lend $500,000. What we do is syndicate investors. So CapGap becomes the single lender on the deal. We consolidate investors on the background. We manage, service, and deploy all funds for the investors and have a bit of a turnkey solution where you can participate with a lower amount of money into a larger scale investment. The other thing that's very, very cool here that not a lot of people know is you might say, this is really cool, but I just don't have that much cash liquid. We can accept registered funds. So in all of our products and offerings, we are RRSP TFSA eligible, which means through your RRSP, your TFSA, you can act like a bank and lend money on mortgages. The other, to guide this back to realtors, if you are ever lending money to clients to help situations, there is some risk and concern there. This is something that we could do on your behalf. So if there's a time where your client needs money to do a deal, you're like, I want to help, but I'm concerned about the optics, I'm concerned about getting involved, you can send them to us, we could do the loan, and we can kind of keep things separate for you. Not that it's a bad thing to do, but it's just something for you to be aware of. So that's the syndicated mortgage model. The trust model. So what people like, the trust model is this. Basically, in the syndicated mortgage model, we all act like a bank. Micah, Brandon, Eva, Greg, and I, we all take our 100 grand, we all pull it together. We're gonna lend $500,000 on one mortgage. Our mortgage is secured against 123 Main Street. We are the lender on 123 Main Street. We know exactly where it is. The good thing about that model is if the borrower defaults, we can foreclose on the property, we can take the deal. The bad thing about that model is if we have one default, we feel it. We're not getting our payments. We're paying the cost of the property. We're dealing with the situation. We have to wait for the property to sell before we get anything. So we had a lot of feedback from investors that they're looking for more diversification. And that's where CapGap Mortgage Trust was born. So the trust is a much lower entry, as little as $10,000, RRSP TFSA eligible, and it's a chance that you or your clients can invest in a fund that does the exact same mortgages that are pooled. So instead of being on 123 Main Street, you're invested in Class A, and Class A holds mortgages on multiple properties. We're generating interest from those properties and distributing it back to investors. As mentioned, this is RRSP TFSA eligible. The other thing that's important to note with CapGap and Banox, we are licensed through an exempt market dealer. And if you as real estate agents, we only allow this for professionals, want to participate in this yourself, or if you want your clients to participate in, we can set you up as a referral agent. So fully disclosed, about on board, about on books. Your client would be aware that a fee is being paid to you, and it would fully disclose. So if you want to be involved in doing this yourself, or you want your clients to be involved, there is an opportunity for you to earn. So yeah.
For those with precs and investing within their prec, is there any issues there?
Not an issue at all. So the first thing I would do is, as I would talk, if you're using a holding company on top of your prec, it may be more beneficial for you to flow up to the holdco. That's not tax advice. Speak to your accountant. But I have many realtors who invest through us, who generate income through precs, and most of them are investing through their holding companies. But we can accommodate precs. The biggest source of realtor investment that we have is we have a lot of realtors who have a ton of money in their RRSPs because before they could do a prec, they were using RRSPs to offset their taxes. And now they got a couple $100,000 sitting at the big green bank not doing anything for them, where they can turn around and use this money to invest in real estate. And I'm going to use this opportunity to talk about, because I think that was a great question, Micah. And as a realtor, if we want to attract investor clients, so clients who are transacting 5, 10, 15, 20 times a year. So a lot of your clients right now might be transacting 5 times over the course of your career. where investors might be transacting a dozen times a year. Is it a good idea to work with investors? I would say yes. Greg, I think you can vouch for that. So I know you have one, we share one mutual client that has done a lot of business over the years. So working with investors is very, very profitable for you as a realtor. I'll tell you Greg, you want to jump in there?
Yeah, I just like my whole business model has always been to get to 7 dream clients at a minimum of 5 deals a year. And ideally 7 to 10, and then maybe shrink that down, right? And so, I mean, I was there and had it like 3 years ago. I've had to drop 2 of them, just probably replaced one on Monday after a lot of work. But yeah, like that is the goal, right? And I mean that allows you to be the investor mindset on that allows you to learn a hell of a lot. Like I have learned more from Dave and Nancy than they've got from me for sure. So then like that's what puts you in the rooms to like actually understand of how to nurture that type of client too. So that's a big part of it.
100%. And this is one of the biggest things an investor wants from their realtor. They want to know that you're an investor too. Do you invest? Do you buy the product you're selling? And here's an interesting thing. When you're investing in funds versus physical real estate, you're also not a competition. So this is a way that if you're investing in different funds like this is a way that you can say to your clients, listen, I'm an investor. I invest more passively through real estate funds. This is good for you for 2 reasons. Number one, I understand the product. I understand what you're doing. This is actually a couple reasons. Number 2, I'm not your competition. My business is to serve you and take my profits and invest in real estate another way, but I'm available and I'm not your competition on these mortgages or on these deals, on these specific projects. So using these type of investment solutions are a way that you can attract real estate investment clients and confidently say, I'm an investor too. I invest in real estate. I put money in these markets. I just do it in a different way so I have more time to serve you on a day-to-day basis. So the funds, I don't want to get too pitchy on this call, guys. I really try not to be. I have 2 mortgage funds, A and B. A is first mortgages, B is first and second, targeted 8 to 11%, RSP eligible. If you guys want to be a bank lender super passively with a low minimum, this is a solution for you. This is a way that you can do that, okay? I want to be cognizant of time here. How am I doing? 10 o'clock, okay. So I'll give you pros and cons between the 2. Direct mortgage investments, 1-year terms. Funds are more 3-year terms, so longer terms, more passive. I kind of talked about the pros already. I'm going to skip through this. So talk a little bit about banks. So I talked about on CapGap Mortgage Solutions, we're consolidating companies, we're mortgage brokerage, syndicated mortgages, private funds. You can be the bank. We can not only provide opportunities for you as realtors to invest in real estate and make profits, we have solutions for your clients to invest in real estate, and we have solutions to help get deals done. Basically, every time I get a real estate lead now, it's so I got this deal, and I start with what's wrong with it, because everyone who comes to me is coming for me where it's a little bit out there. There's something different about the deal. So on CapGap, that's why we changed the names. We're Mortgage Solutions. We're transactional engineers that solve real estate problems. Now, what is Banox? Banox was launched in last year, about a year ago, or early 2025. And it's my newest company, but I really like to say it's my oldest company. Banox is the consolidation of my entire real estate career. I am moving assets that I have built, acquired, and managed into the REIT that will be launching soon. I use the bridge fund to fund the projects that I pick and choose and highlight and spend most of my time and energy executing. So Banox, somebody asked me the other day, well, I'm waiting to invest in Banox. It's the newest company you have. I just want to wait and see. And it really dawned on me that Banox is not the newest company I have. It truly is the oldest version of what I've been doing, packaged in a new form. So essentially, it's private equity. So this is an opportunity where people are partners in real estate. And where I want you guys to see this is another potential opportunity for you guys as realtors to find ways to get your clients more capital. So I'm going to talk about what I do, but I want you guys to be thinking about in your business, in your real estate, who are clients that if they had a tool like Banox, how much more capital could they create and how many more deals could they do with you? If you're trying to get Greg's 7 dream clients, if they have a fund like Banox, their capital becomes, I don't want to use the term infinite, but substantially more available. So it's a bridge between investors and non-traditional banks. Essentially, it's a partnership vehicle. So I got to give the disclaimer again before you invest. Lawyers, accountants, get legal advice before you sign anything with us. You read our declarations, our term sheets, all of that, our offering memorandums if the project applies to it. So and I think this is another important. I'm going to talk about this. I came from the real estate investment worlds. Who here has been to a workshop, where they come to the workshop, they teach you about real estate, they get you all jacked and excited. What they don't talk about is the risk. Brandon, yeah, you've been there. So they get you all jacked and excited, but what a lot of them don't talk about is the risk. And there is risk in investment. And what the products that I've built carry risk. I can't say they don't carry risk. But what I spend a lot of time doing is thinking about the downside and how to protect that. And the shortest answer with Banox is built for any of the downside in real estate, we're just not going to sell. We're going to hold. We're going to wait until better market conditions. And we want people to invest in our fund that have a longer term vision on capital, believe in the projects they're investing in. And if we get to the end of a term and the market's not great and it's not going to be super profitable, we're going to hold. We're going to wait for better conditions and sell at a better time. So, Eva, another note, I got to get updated pictures. This project is way farther along. The Class B, this is the bridge fund. This is the fund that primarily funds my deals. So if you want to partner with me on my projects, I don't do shared equity. I do fixed rate. So this is a $20,000 minimum investment. It's a 12% target. So every 2 years we distribute 24% total return. Structured as a limited partnership. It is RRSP eligible. And right now this is funding 2 of my main projects, which is a 12-unit build in Grand Bend, which will become the Kiwi Suites, and a 29-unit conversion in Kitchener. I know there's been a lot of talk about this. We actually got our permit with the water hold. Big shout out to, I don't know if I should say his name on the call because I know it's being recorded, but there's a member of the collective who gave me some good advice on how to help get that done. So really appreciate that. We got the permit to build. Even with the increased units and the water hold, I don't want to say there's ways around it, but if you know what you're doing and you are using facts and data, you can still get things done. So Class B, bridge fund, $20,000 minimum. We have people up to hundreds of thousands of dollars to invest in this. It's a $12 million cap. And the reason why it's a $12 million cap is that is basically the threshold that I have to operate in within a 2-year term. That's about how much money I can effectively deploy and manage in my internal business, not client funds. In terms of client funds, we're well over $100 million in terms of loans and other assets. But in terms of my personal portfolio, $12 million is kind of the range that we can effectively manage. So if you like what we do, like what I do, want to be a partner in the closest element of my business, the bridge fund is the way to do that. As I mentioned, RSP, TFSI eligible. As the realtors on this call, if you have a client who's struggling to grow their real estate business because of capital, have them book a call with me and let me start teaching them about how to create a fund like this. Because if they can create a fund like this, it accelerates their ability to buy and execute more. And for you as a realtor, ultimately, more transactions. Class C, Waterloo. So this is almost done. I think we are under 150,000 left on this. This is located on King Street between basically Morty's and McDonald's at King and Columbia. Realtors on the call, is this a good location? I did another call and It was recorded, and somebody made fun of me in the comments. Dude, we get it. It's a good location. You said good location like 12 times.
Yeah, it's
So,
arguably one of the best locations in Waterloo. Yeah,
right. Greg, do you have a comment on that?
McDonald's not as
Yeah,
good locations, I would
I
say.
was I was super uneducated when I started in real estate in 2017, and I could have listed the building at the corner of Hickory and King, just down the street from there.
Yeah.
And it was an old antique shop. Michael will remember it from high school and shit. It was an Asian lady who owned this antique shop for or whatever, glass shop forever. And she had this insane number on it. And whatever her insane number is, it's worth like probably 5 times that now. Or 10, maybe 10. Like it has every if you go look at that plaza now, it has full commercial. I think there's like probably 10 commercial units downstairs now,
That was
and then a full
the
top and then a
China.
tower.
What was that? The China shop?
Yeah, yeah.
Yeah. That was
She called me.
that
I
was a
don't
cool.
even know. She called me direct, and I just turned it down. I was just like, nah, so dumb.
Yeah.
Oops.
But so it's an amazing location. Yes.
It truly is. So I'll tell you the cool thing about this project, and we took a unique perspective. And this is as you start to work with me, if you ask me questions, this is I take a unique position on a lot of things. We actually bought this property out of a power of sale. We had the debt on the property. We converted the debt to equity and bought this property. And when we bought it, there was 6 houses on the property. And the 6 houses were dilapidated. Total 45 beds. Less than half of them were rented. Condition was terrible. 2 of the houses were not even being used. The garbage everywhere. The whole site was a mess. And I put together the fund, raising $4 million. Like I said, we got about $150K left, $25K minimum for anyone who's interested. And I took a very unique position where our goal is to get site plan approval. We're in our 3rd submission right now for this 25-story building. And look to partner or sell with a developer who's ultimately going to take us out. And one thing that I did was very against the grain is as part of our performa is we spent money fixing up the houses. And a bunch of people said, well, Kyle, we're tearing this down. We're trying to sell this to a developer to build a high rise, and we're spending money fixing up the houses. Why? It was a risk mitigation strategy. In case something happened, we had income on the properties. So in case something happened, the 6 houses were being rented out to students. They were easy. So just so it said, and people are like, well, if you rent it out, can you kick out the tenants? It's very easy when the buildings are being knocked down. So yes. So we're renting them out. We still have some final vacancy to fill in September. But this mitigated risk. We weren't in a position when we had to sell this property that we were burning cash every month. We had income coming in via rents. And where this got really interesting was, people, I maybe looked like a little bit of a genius in some degree, because what if something happened? Well, did something happen between last year and this year in Waterloo about development? The water constraints. So this has put us in a position now where we can get the site plan approval. There will be a holding provision on the water. All that's being worked through. I have some confidence in the city's ability to find a solution over the next couple of years. But what we were able to do is we generate rental income on these properties. Now, when we sell, ultimately, we're selling from a position of strength. My crystal ball on this now is these water constraint issues are going to ultimately drive upward pressure on value. Once this is rectified, there's going to be major demand, and we can sit in a position, hold the asset, cash flow the student rentals, have the site plan with holding provision in, and once we get the green light to go, we're now in a position where we have a site plan approved cash flowing asset that's ready to go, and we're not selling from a position of weakness. So that was a strategic plan. But once again, this is a structure. I want to give you guys value from real. I don't want to be pitchy here. If you're interested, love to have you involved. But if you are, this is a structure that allows people to partner on large scale real estate projects. We got a mortgage and we got equity from investors. And the equity from investors came from RRSPs and TFSAs. So people who have long-term money that they want to invest in, they own a piece of this project in their RRSP. So if this is a structure that you think could be helpful for your clients, I'm happy to share insight on how that works. REIT, this is coming soon. It's going to be launched in the next couple months. I'm going to say, I shouldn't say weeks. It'll probably by midsummer, the REIT will be launched. The REIT is going to be rolling up all of my apartment building assets. There's about 5 assets that are going to be rolling into the REIT. Basically, you can own a small piece of a big building. That's the simplest version of a REIT. Great for RSPs, great for TFSAs, great for holdcos, precs, whatever that is. This is a way that when you're talking to investor clients, you can confidently say, I'm a real estate investor. I invest through REITs, I invest through private equity, I invest through mortgage funds, and I do that so I have the most time to spend with you. So I take the profits from my realtor business, park them in real estate. I believe in the product, but I don't buy and sell to compete with you as much. I go on that side so I can spend my time with you. So that's the REIT. I'll throw one more up here. This is going to be gone very soon. We got about 1 million of the 1.5. This is closing in the next couple weeks. This is a 20-unit building in the big town of Lucknow. For anyone who knows, this was another take-back deal. This was a mortgage that went sideways, and the benefit of being the mortgage position is you have first right to crack on this deal. We looked at selling it, what we could sell it on the market for versus what we could acquire it for and get CMHC financing. Returns really attractive. This is a one-off deal. Eva, quick edit, it needs to be 5-year terms, not 4-year terms. 5-year term, this is a buy and hold, this is a boring investment. We're going to hold the property and we're going to get approval to add 16 more units on it, either build out the 16 units or sell it. So once again, this is a 20-unit building with 12 storage units. I've got 1.5 million of investment. Right now, half of the 1 million committed is RRSPs and TFSAs. People are buying assets in their registered funds. If you think, if you are looking for ways to get your clients more capital to buy more deals, I promise you, if they can get access to RRSP money to buy real estate, the amount of capital they have to spend will go up infinitely. People are way more patient on their investment strategy in their RRSPs than they are with their cash. So, like I said, I'm trying to keep this. These are offerings. You can invest with me. I don't want to be too salesy with you. I want to give you guys value for your real estate business. Essentially, and Eva, this is another note for the next presentation. I appreciate you guys letting me do some notes to my team here. Banox is not the newest company, it's the oldest company. It truly is my now decade plus of real estate experience. I've been investing for almost 14 years now. My first investment when I was 22. So Banox is the consolidation of my entire career into one company, and I'm super, super excited for that. So any questions? No wrong answers, except can you repeat them all again? Happy to do any Q&A, guys, on anything specific. Questions about real estate, how you get your clients involved, whatever it is you want to chat about, I'm happy to do it.
Kyle, that was really awesome. Can you dive in a little bit about how you create funds? What properties are you seeing over the next couple of years that would fit well into creating a fund in the event that let's say the collective, for
Is that
example.
me freezing or Micah freezing?
Oh, am I
It's
freezing?
Micah.
Okay.
Can you hear me now?
Yeah.
Can you explain, like, what is the process for you to look at certain properties and say, this fits the bill for a fund? We should look at building out one of these assets and create the creation of that fund.
Yeah. So the main focus is going to be on things that distribute. So, in full transparency, I'm comfortable sharing this to everyone in the group. Like the Waterloo project that doesn't distribute has been the hardest capital raise I've ever done, because it's a long-term capital raise with no ongoing distributions. So in the question of what you said, where's the money moving to? People are looking for things that distribute. So it doesn't necessarily have to be monthly, even quarterly distributions. Most people are happy with. I still remember, this isn't me, this is a story of my mentor. And he used to tell me that back in the day, he used to have this 8-plex, I think it was in Gravenhurst, and he had partners on the deal. And every quarter, no matter what, he sent a distribution check. And sometimes he said it cost more in postage than the distribution check equaled. But he said every single quarter his clients would call, thanks for the check, man. That's great. Thanks for the check. The check was in the mail today. And he's like, it was $24 the 1 month. And people are calling him, thanking him. So if you're looking at creating this stuff and attracting the most capital, I would highly encourage things that distribute. So we are moving more to the apartment side than the development side. We still have some development projects. And the thing to remember is different strokes for different folks. The development projects can hit higher. So if you don't need distribution, if you have your RSP and you have a 10-year time horizon, you might say, I'm okay with no distribution if I can hit that higher threshold of
What it is.
But if you're looking for most capital and right now and the most straightforward to raise on, something that distributes, apartment buildings are considered to be the most recession-proof vehicle out there. When the markets crash, people still need a place to live, they still rent. Even though we're seeing some downward pressure on rents right now, you can still rent. You just can't get that crazy 2022 price.
Okay, keep in mind I don't usually log in with the info at.
LA, you're chatting here.
I usually log in.
LA, do you want to mute?
I don't usually log in with the info at. I usually log in with the CapGap.
Can you mute LA?
I got her. There we go. You've been silenced, LA.
Yeah, I guess if you had 150K or let's say 200K, and you are going to direct someone towards like a moderate risk REIT, something with distribution, what do you set the expectations on that distribution percentage wise? Like what are people looking for on distribution?
So
and I guess or because I'm assuming it's either distribution or exit are both of your things that you're considering are like those are two biggest questions by people, I would assume. How do I once I give you my 200K, how the fuck do I get it back? And then
So I'll answer this in a few different ways. So first of all, if somebody comes to me with 200K right now, typically what I'm doing is I'm spreading across the funds. So similar to like a financial advisor would do, I would say, let's do some more conservative CapGap A. Let's do some maybe split between A and B, a little bit more conservative, more aggressive. We'll do some bridge fund. We could partner in one of the projects, either Waterloo or Lucknow, and we spread it out. So we take 33 to 50K per fund and we spread it out. And this kind of goes, so that's the first question. Then the question would be about what are people expecting? And I'm going to kind of tie back to what I talked about of consumer versus investor. If you're never invested in real estate, you've never been to a real estate workshop, a lot of these people are like, oh, an 8% return? That's fantastic. I'm happy with that. In CapGap A, 8%, it distributes monthly. That's awesome. I'm okay with that. Now, if you talk to somebody who's owned rental properties for years, they've done development deals, they've been in real estate, those people have a higher threshold and expectation for distribution. So the question really does range based on the person and their own experience more than risk tolerance. Then it gets into the risk tolerance question. So if I compare, and I'm going to use my products just because I know them the best, CapGap A is an 8% first mortgage only. Right now we're at like a 50% fund loan to value, and it distributes 8% monthly. If you have more money and you're closer to retirement, you might say, I'm good with that. That spits out cash every single month. I'm going to start drawing on my RSP. I want something consistent. I want something stable. I don't want the highs. I don't want the lows. I just want something, a lower rate of return that's consistent, but it's backed by real estate. If you're somebody else who's maybe more in the prime of your career, 10 plus year time horizon, you're going to invest your RSPs or your holdco, and you really don't need the money. You really don't need a distribution. And you like the idea of swinging for the fences a little bit more and hitting a 20% annual. Now you go more to like the Waterloo land development style deal where you're partner in a major project and you're in a position where you're just going to wait it out. You're going to sit in that. You're going to wait for a longer term. If I use the water to answer your question, if I use the Waterloo example, I have several clients who've come to me with 200K who have been like more, they kind of came to me for the Waterloo deal because they liked the 20%. But I then shifted them away. I said, out of the 200K, let's put like 30 in Waterloo because I don't want to tie up that much of your capital if your life changes in 3 years. Let's take a small allocation in a longer term equity piece and then spread the rest out into shorter term stuff that with more frequent distribution. So did that answer your question, Greg? I tried to cover a lot of things there.
Yeah. So yeah, but if I'm okay, so if I'm me and I'm 42 and I'm looking at so like my friend so like a lot of my friends are super heavy millennials are benefiting just as much from like a lot of the millennials who bought early, right? The millennials who bought in 2006, 8, 10, anyone kind of before 15 is in a really good, decent equity spot that they probably, well, that they for sure didn't expect to be in or shouldn't have expected to be in. And so, like trying to deploy that on 5 year terms, right? Because I feel like people can get their brains around 5 years, and I want to like have these conversations. I've had these conversations with people who, anyone who comes with me with investors. I'm just like, hey, like, do you have REIT? Like, do you also own in a REIT to try to de-risk yourself on whatever that Mount Forest might go to shit or that Lynchville might go to shit or whatever? And so like I've been directing that for a long time in that, and it's like Andrew does a lot in that, and so it's like how do we have those conversations to get them over to you, I guess, and then like because I think that having that conversation just creates more deals too, right? Like if they may end up, if they have 250, they may end up giving you 100 and then buying a investment condo, which they maybe should do as well,
Well, and Greg,
right? So
let me add to that question. Like, how does one take equity from their home to do something similar? Because you talk a lot about RSPs and GSEs and other like
yeah.
government-based funds and TFSAs, but how does one do that with their current equity?
Yeah. So just so you know, Greg, to start with your question, my general philosophy for people is take your registered funds and invest passively longer term in funds and private lending. And if you're going to leverage home equity or your cash, use that to buy your own physical real estate. So I get that all the
So
time where
yeah,
people
that's
come to
fine.
me
I'm
with
making I'm also making the assumption that they have $100,000 in their RSP and you can draw it from either side or whatever, right?
yeah,
Um, so okay, so that's I mean that is a good function of that. And to follow up with Micah is to be like, okay, you have this sitting over here. This is deployable very easily, right? Like the TFSA and RSP, you can hook that up. That's a pretty easy process, I'm assuming.
yes.
Yeah, that one.
Yes.
So
Compared to drawing out of your house, yes.
now we get into the leverage conversation, okay? And this was a lot easier conversation to have a few years ago, and we sound the alarms like there's risk to leveraging your home equity. But the first conversation is, and maybe I think a lot of people know this. What is the return on your home equity?
Like what's return rate per year?
Yeah, on your home equity.
No, right
Well,
now it's zero.
well, well,
You're essentially looking at market increase. You don't have any equity. There's
and
like no
So
return per se.
let me go another. What the market's doing is actually irrelevant to the return on your home equity. Because if you're fully leveraged, you get the same rate of return. If you borrow 100% of the equity out of your home, the value still goes up. So your return on your equity on your home is, in my opinion, it's zero.
Mm-hmm.
Because and it's actually, if I'm leveraged, I'm getting a higher rate of return on the equity that's left because I have less money in the deal. That doesn't mean the value of your home's not going up. So that's the first shift for people about, do we leverage our house? Well, my house is going up 5% a year. Well, whether you owe 100 or 500, your house goes up or down regardless. So that's the first shift. Is, where does pay off your house come from? I'm going a completely different way here, but where does the pay off your house come from? Does anyone know where that came from?
Our parents.
And where did they come from them? Their parents.
Yeah.
In the Great Depression in the 30s, people were paying their mortgages and houses were being taken back. So this is a 100-year-old thing that were pay off your house kind of, people were paying their mortgages, they were making their payments, and banks were foreclosing and taking the houses back. So that's where that has become ingrained. You pay off your house. Now, our parents, they had mortgages in the 80s and 90s. It was 19%. Should we pay off our house? Yeah, we should. If we're borrowing at 18 or 19%, we should absolutely pay off our house. But if we're in today's market right now, and you can get a bank rate at 3.5%, on a HELOC 4.5%, can you outperform the market? Can you get a higher rate of return? So I like to use the private lending rule. And private first mortgages right now on a direct lending syndication, you can get 11%. So if you leverage equity out of your home at 4.5%, so the bank has a first position charge on your house at 4.5%, you can turn around and lend that money at 11%. So you get my math's a little bit, 6.5%, 6.5% spread on that money. Should you do that? I'm fully comfortable with doing it. I have no issue. I got a mortgage, I got debt on my house, but I have a first mortgage on another house. I can sell that asset, pay it off. I'm okay with that. So that's a risk tolerance question. So when we get into but should we leverage our house to buy real estate? There are some beliefs that we have to address first with people. And these are some of the conversations that I have. Once we get past all that, we have to have a conversation with both spouses and make sure both are on board. What's the threshold? What's the limit? How much are we comfortable doing? And then we can talk about allocation. So let's say they have $500,000 of equity in their house and they're considering doing $250,000, 50% they're going to leverage out. The first conversation I would have is, should you take 100 of that and max out your TFSA? If you don't have money in your TFSA, that's the one nugget our government gives us. Max out that TFSA. Now you still have 150. You can take 100 in your TFSA, spread it out over funds, and then take that other 150 and look at going to buy physical real estate. Buy an investment property. Buy something that you own, control, and manage. What we're seeing, and this is the long way back to your question, Greg, about these fund conversations can tend to drive real estate purchases. And it goes both ways. I talk about funds and I have people that say, I'm really excited about it, but I'm going to invest my RSPs with you, Kyle, but I want to go do what you're doing. Like, I don't want to be the guy putting together the deal. And we have other conversations that go the other way where we get leads from people who said, I've been showing this person houses for 2 years. They're not pulling the trigger. I think they should just invest with you. And we pay referral fees on those. So don't worry. If you've been showing for 2 years.
Yeah. Cool. All right. That helps.
So leveraging the house out, happy to have those conversations, happy to meet with those clients. We still deal with the banks. We can absolutely do it on that side, or some people, they just want to deal with their bank. We can kind of coach them through what it looks like to get them set up to access the equity and then show investment options after the fact.
Yeah. Okay.
That was
Awesome, man.
super helpful. Yeah, Kyle, thank you so much. We're at 10:30. I mean, Kyle's been with us for what, 8 months now. And I think this was super important just to make sure that everyone in the collective and people that are obviously really interested in bringing greater value to their clients, their client base, their investors, and even, potential family members that have equity and some monetary funds to play with. It was really important today to fully understand what Kyle brings to the table, not as a mortgage broker, but as an investor, as an advisor, and still an EXP realtor. So, Kyle, thank you so much for your time. Really appreciate your expertise, and thank you all for joining us today.
Thanks, everyone. Appreciate it.
Peace.
Yep.